Good morning, good evening, good afternoon, depending upon where you are on our beautiful planet today. Thank you so much for joining us here at Trade Delicious. We're super excited to share a collection of different information with you today. And today is Educational Day. So I'm going to talk to you guys specifically about an economic news event that moves the markets. I know everybody wants to get to trading, charting, and preparing for their day, so I'll make this quick. Let's jump straight into it. Namely, the CB Consumer Confidence Index. This is a news event that comes out monthly from the Conference Board. The Consumer Confidence Index, often referred to as the CCI, is a report that measures the level of consumer confidence and economic activity by way of a survey. This data is given from the Conference Board. It's a global think tank with locations all around the globe. Think of it as a nonprofit that just likes to have this information around and provide it to the masses. They really are doing a great service. We'll talk a little bit about how that differs from the Bureau of Labor Statistics and things like that a little bit later. But as we continue, let's talk about the headline, the big number, right? So, like with everything else, the big number here is going to be the headline figure. The headline figure is the figure that is the most important. You're going to see this posted next to the event if you look at any major site like investing.com or anything of that nature. The headline figure in this case measures solely the reading for the month relative to the baseline 1985, representing a 100 reading. That's a lot of gibberish. What that means is this number is, for example, in April it was 101.3. That's better than what it was in the year 1985, which is what the Conference Board, uses as a baseline, meaning that we're more confident than we were in 1985, meaning that we're bullish. That's basically all that it means. There are some additional numbers that are printed with the consumer confidence, the CCI, the index. The present situation index, the expectations index are a part of that, but like everything else, the headline is the most important thing. That's what we're going to be looking for. We're going to be looking for how expectations measure up to what's actually printed for the figure. When deep diving into it, there are a lot of things that go into this particular event. This particular event measures the degree of consumer optimism relative to the state of the economy through the eyes of consumers. There are very few economic indicators that do this. There are very few economic events that do this. The only one that does it very similarly is the Michigan Index, where they do something very similar. They just send out surveys to a collection of different households. In this case, the CCI sends this survey out to 5,000 households, and they survey them on 5 topics. The whole idea here is, if consumers are more confident, if households are more confident in the economic situation, they'll be more willing to spend money. If they're more willing to spend money, GDP grows, and so on. This is what we're talking about. Now we're getting into the bits and pieces that are important about this particular event. They're surveyed about a few different areas, 5 to be specific. They're surveyed on current and future business conditions, current and future employment conditions, and finally, total family income for the next 6 months. As you can see, 3 out of 5 are focused more heavily on the future. So they're weighed more heavily. In fact, future items are weighed 60% versus 40% present items looking at the CCI. All the options for what they can choose in this survey, these families that are being surveyed, they're either positive, negative, or neutral. And an equation is created between those 3 in order to give us our number at usually a baseline of 100, just a tad bit below 80 is going to be bearish, above 100 generally speaking is going to be bullish, anywhere in between can be seen as neutral, but like with everything else, context is king. Now, diving in a little bit more into some of the specifics of this, you're going to see, like every economic event, things get muddled by different things. There's no economic event that is perfect. Like we just said, context is king, right? So this particular event, the CCI, coupled with its subsidiaries in the present situation and expectations index, they're going to be heavily affected by things that happen in the news. Look at what happens in 2008. A little bit before then, we start to see the present situation. In other words, what those 5,000 households think about the strength of the present situation of the economy. starts to fall aggressively, whereas the expectations index, we start to see something very similar, where things start to fall aggressively. Why? Because in 2008, housing crisis. I don't have to tell you, right? We start to see things fall quite aggressively. We do start to see some divergence here as people believe that, hey, we're still in a really rough situation, although we had expectations of being much stronger, and in reality, there isn't much in terms of an economic recession. I know that that's potentially insensitive to say, but when looking at the numbers, it's not nearly as bad as it was between 2008 and 2009. As a matter of fact, on this chart, you'll see that these shaded areas are representative of years that GDP did not grow. So between 2008 and the middle of 2009, we saw some difficulties, some neutrality within GDP, and the same is true, of course, in 2020 following the pandemic. But look how aggressively consumers took that information. Look how aggressively consumers took the pandemic. People were scared. And that shows up quite well in these indexes. So keep that in mind, that these figures, because we're talking to real people, this isn't economic data that's based on numbers. This isn't like PMI where we're getting straight numbers from manufacturers working in the industry. These are normal people. And so that's going to be a very big part of this economic event. And it's one of the things that makes it unique. As I already said before, anything below 80 is going to be considered recessionary conditions. And these readings are incredibly volatile. Current events are going to play a big role. Terrorist attacks, pandemics, etc. will often produce a negative sentiment regardless of whether or not we're in a negative situation. Consumer spending is a huge part of GDP. This chart that I'm pulling here is from the St. Louis Fed. If you ever get the chance, please take a look at Fred. Fred's a fantastic guy. Joking. Fred is just their Federal Reserve economic or educational database. As you can see, personal consumption expenditures, otherwise known as consumer spending, has grown exponentially as a part of GDP. In fact, in the first quarter of 2023, it was 68.3% of GDP. That means that consumers last year spent 17.4 trillion with a T, dollars, according to the U.S. Bureau of Economic Analysis. Since 2005, spending has fallen only twice annually, in 2009 and in 2020. Surprise, surprise, right? Now, that means that GDP growth is heavily dependent upon consumer spending. As consumer spending grows, so does GDP, which is good, right? Maybe? Sometimes. The answer is sometimes. In normal economic conditions, of course, growth in consumer confidence and the CCI is great for the economy. As GDP grows, more money floods the system, gives more people opportunity to make more money, more businesses are being built, and so forth. However, 2023 is different. It's been different since the pandemic. We are facing intense inflationary issues. And as GDP has grown, as consumer spending has grown, so has inflation. The more people spend money, the more we're going to see these inflationary pressures continually mount. And although GDP growth is incredibly important, the Federal Reserve is not focused on that right now. They're focused on inflation. Any strengthening of consumer confidence and therefore an increase in consumer spending would be a massive problem for the Fed. They're looking to curb spending to halt inflation. Can't talk today. In its tracks. Ironically, a strong reading for the consumer confidence, CB Consumer Confidence Index, could be perceived as bearish, since the Fed may respond with more rate hikes. So that gives you an idea as to how CB Consumer Confidence Index plays a significant role, not just generally in normal conditions, but also in the conditions that we're facing today, which, as I said before, are unique, but it's what we got. As always, thank you guys so much. Today's going to be a little bit of a short day. Really appreciate you guys coming and learning about these economic events and these economic conditions. Please, as always, trade well and trade delicious. Thank you so much for your time. Hope you guys have an excellent rest of your day. I'll see you.